So understanding spread, slippage, and the major and minor forex pairs. So a lot of us might know how spread is calculated or what slippage is and why it happens. And some of us may not know what the major FX pairs are and what the minor FX pairs are and why are they called major and why are they called minor. So let's start off with spread. So what is spread? A spread is the difference between the bid price, i.e. the price that the trader can sell the pair at, and the ask price, the price the trader can buy the pair at. View spreads as the business cost for the broker who allows you to trade the markets through them. And the image on the right shows a spread of 1.7 pips or 17 points, which is this one over here. The difference between 108,378, which is this, and 108,361 is 1.7 pips. So that is the spread. That's simply what a spread is. It's just the difference between the bid price and the ask price. So there are two types of spreads, fixed and variable. A fixed spread is when the spread stays constant no matter the market conditions. So the broker, a lot of the FX pairs that a lot of brokers that we're in or we have are not fixed. You might have a fixed spread if you use like a prime brokerage account, which is through like an institution like Citibank or Goldman Sachs. They will tend to have like prime brokerage agreements with you, but you will need to have a lot of money and you will need to be a client with them. And of course, that is our goal, of course, for all of us. But that's for much down the line, of course. So variable spread is when the spread moves with market conditions such as volatility, if there's liquidity issues, and the broker specific model. If the market is experiencing large amounts of volatility, you would expect spreads to widen. The majority of retail brokers, as I mentioned, have a variable spread. That's why, the spread is always increasing and decreasing. If it stayed constant, no matter what time of the day, what's happening with the news, you're on a fixed spread, but a lot of us are on variable. So this is why when markets are experiencing large amounts of volatility, like during an FOMC meeting, you tend to see spreads widen as the business cost for the broker increases and they pass that on to you as the trader. That's why spread increases, because one, there's lots of volatility, and therefore it's more risky for the broker to facilitate your trade. That's why spreads move up and down. If there's less volatility, that's why your spreads tend to, narrow, and it's very nice spreads because there's not much risk for the broker. So that's simply what spread is. So what is slippage? Slippage occurs when the markets move quicker than the order can be executed. You can have both negative and positive slippage, of course, just depends on if you bought or sell or sold. Slippage tends to happen when there's large amounts of volatility. If there's a large trading event like CPI, for example, you would expect to see volatility and as a result, a higher probability of slippage occurring. This is why sometimes your order doesn't fill in time and you can run at a loss if the markets move too suddenly. Also, you may see slippage if there's lower liquidity in the market, as it takes less money to move the market. So think of it like a pot. If there's less money to move that pot, the higher likelihood is there might be some slippage there. If the broker isn't able to fill the order on time, it's like when you click buy on MetaTrader, that goes through the system, through into the brokerage, and then they execute the trade. Ideally, you want to be with brokers who have access to a large liquidity pool, which is provided by liquidity provider. If the broker's systems are very fast and is something for you to consider as well. You ideally want to go with a good broker. And this is why sometimes when you go with really dodgy brokers, you tend to have more issues than it actually solves. So I always tend to stick to the most best brokers out there at the moment. So do your own research, of course. But ideally, you want to be with brokers who have a very large liquidity pool, which is obviously provided by the liquidity provider. And if their systems are very, very fast, that's how you reduce you might sometimes get slippage, but the probability of you getting, slipped out is much less when you're with a very, very good broker. So what is the major pairs? The major FX pairs are the most traded and typically have the most liquidity. It takes more money to move major pairs due to the depth of liquidity. So as you know, the most traded pairs are like Eurodollar, GU, USD JPY, US dollar Swissy, AED USD, USD CAD, and NZD USD. And this is why that's why generally the spreads on those pairs are a lot better than likes of pound versus the South African rand. You have a much larger spread on that pair because there's less liquidity. Less traders trade that. And the opposite of minor pairs, or what is a minor pair? Minor pairs are known as the crosses and are seen as the pairs that don't include the dollar. So, for example, the major ones we were talking about AUD/USD, GBP/USD. In this example, minor pairs tend to be less liquid and are less traded and can have larger and more volatile moves. And that's why, remember, think about it like the opportunity cost and the business cost for the broker. If you're trading more minor pairs, you tend to see larger spreads because it's slightly more risky for you to sort of trade that. And if you trade these pairs like a GA or GJ or Euro Yen, you're likely or higher likely to get slipped out. Doesn't mean you're not going to trade it. There's still opportunity there. Just know that, there's a slight higher probability of you getting slipped out. Slippage doesn't really occur that often. What I'm saying here is it's a little bit more likely to happen with minor pairs than major pairs. You sometimes might get slipped out on a major pair, but that's not because of the market. It's more likely because of the broker. And this is what I'm saying about you have to, you want to be ideally choosing brokers who have a much larger liquidity pool, so you're less likely to get slipped. And of course, their systems are very efficient and fast. So that is simply what spread is, what slippage is, what's a major FX pair, and what is a minor FX pair. We'll see you in the next video.